A lot of traders talk about the importance of correlation, but how many of them actually use it in their trading? In a world where we never know which way the markets are going to go, or when they will make their move, or how far they will move, correlation is one of the few constants, or at least almost constants, that we can hold on to. Yet, very few traders use this powerful indicator in their trading. So, why? I think there's a perception that trading correlations is highly complex, and that you'll need a bank of computers whirring away in the corner of your office to analyse the data. Well, monitoring correlations can be time-consuming if you're watching every stock price in an index or every forex pair, but I'm going to assume here that you're not managing millions of pounds that you have to keep balanced across a vast range of markets. If you stick to just one or two correlations, you can build yourself a very neat little profit taker. Correlation is all about the invisible strings that tie different prices together. It's about a hurricane in the Gulf of Mexico instantly affecting the price of crude oil and then influencing the price of the Canadian dollar. It's how what's going on in the Euro-USD pair is likely to be similar to what's happening on the GBP-USD pair, or how the Canadian dollar is closely correlated to the value of oil, or the Aussie dollar follows the price of gold. Around the clock, electronic trading and high-speed information technology means that today's financial markets have become more correlated and interconnected than ever before. On market indices like the FTSE or the S&P, correlation between individual stocks is growing too, and stock pickers don't like this. It means that stocks are just moving up and down in bulk, with little link to the fundamentals of that particular company, and it makes a mockery of all the time they spent poring over the company reports. Sure, in part this is to do with global concerns. The macroeconomy is the driving force, rather than the earning potentials of the individual share. But for anyone looking to use correlation to their advantage, this is good news. This is one indicator that seems to be getting stronger and stronger. But there isn't a button we can click on our charts that makes it magically appear. So how exactly do we use it? Correlation is measured on a scale of -1 to +1. If a pair moves perfectly together, then the correlation will be +1. If they move together, but in opposite directions, then the correlation will be -1. And if they show absolutely no correlation at all, then the figure will be 0. So we're looking for something with a figure as close to +1 or -1 as possible. The 50-week correlation between the pound yen and the dollar yen at the moment is 0.98, which is a nice high figure. So if we have chosen our pair, what we have to wait for is for them to move out of alignment. Then we can bet on them moving back together. Range is an important factor in correlations. Markets may move together, but a large market is likely to be making bigger moves than a smaller one. When it comes to our pairing, the pound yen has a larger range than the dollar yen. This means that if the dollar yen market moves, we expect the pound yen to make a bigger move. So our trading opportunity happens when we catch the pound yen lagging behind the euro yen, because then we know that there's a high probability that the pound yen will snap back into alignment, catching up with the dollar yen and hopefully overtaking it, which gives us a great high probability trade. Correlation trading is one of the most savvy trading styles out there, and something that all traders worth their salt should be aware of. And with correlation on the rise, I predict this is going to be an area that many traders move towards over the coming years.